Debt market update, August 2023. G-Sec yields inched up during the first half of the month, driven by a rise in US yields along with resilient domestic growth and a spike in CPI. However, yields fell on the back of strong buying by banks and insurance sectors, and 10-year G-Sec yield ended the month at 7.16%, down 2 basis points on a month-on-month basis. The other factors and events which impacted the yield movement include rise in crude oil prices, resilient credit growth, downgrade in US credit rating by Fitch, introduction of incremental CRR or ICRR by RBI to drain out liquidity, etc. The yield at the short end rose on decline of expectations of a rate cut in the next 12 months and introduction of ICRR. Corporate bond spreads widened compared to last month. Average interbank liquidity declined month-on-month, driven by additional 10% cash reserve ratio introduced by RBI on the increase in deposits between 19th May 2023 to 28th July 2023 to partly blunt the impact of higher liquidity because of recall of INR 2000 banknotes. FPIs bought, including voluntary retention route, debt worth USD 0.6 billion in August 2023. Cumulatively, FPIs have bought debt worth USD 2.7 billion in 5 months FY24, vis-a-vis being a net neutral during the same period last year. Outlook. The minutes of MPC meeting held between 6 to 8 August 2023 were largely in line with expectations, with most members reiterating the commitment of reaching the inflation target of 4% in due course, and also took comfort from the resilient domestic growth. During the past few months, the yield curve has flattened significantly as robust economic activity and above-target inflation has pushed out the expectations of rate cuts in the short term. We remain optimistic on the fixed income outlook as several factors are favorably placed. CPI, especially core CPI, has eased significantly from the peak and is likely to ease further in view of decelerating momentum, lower input price pressure, and benign global commodity prices. Slowdown in services as well as goods exports, decline in fiscal impulse, and soft private consumption are likely to weigh on growth. Further, adequate foreign exchange reserves should keep pressure on INR at bay. It is widely expected that RBI is likely to maintain pause for an extended period, and the bar for restarting the rate hikes is high. All the aforesaid factors bode well for the fixed income markets. Sustained rise in oil prices, robust credit demand, risk of fiscal slippage, and continued global monetary tightening are key risks to the outlook. Lower G-Sec demand from insurance and PF sector and higher supply of state development loans in FY23 to 24, etc. could also keep the yields at elevated levels. On an overall basis, in our view, yields are likely to trade in a range with a downward bias. While we continue to recommend investments into short to medium duration debt funds, investors could consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.